A lot of people are asking for BWY. Paul.
BMY.
Thank you so much. BMY, bowel movement yearly. It's the magazine. No, what company is this, Paul?
Bristol Myers Squibb.
What do they do?
They're a drug company.
Mo, what do you know about these people?
I know a lot about them.
Well, tell me, because I don't know anything.
They make a lot of cancer drugs. They're a great company. They're very big. They just acquired Celgene pretty recently. And yeah, let's see.
All right, so guys, this is a $140 billion company. They lost $9 billion last year. More on that later. So they have no PE, that's an X, and their profit margin is negative, that's an X. Another reason why we're getting a profit margin. But here's the interesting part, guys. This is why you guys are smart for learning from us. $9 billion loss, but look at their free cash flow. $13.3 billion to the positive. So this tells me there was some major write-off here. There was something major that happened.
Matthias saying bad profit because of acquisitions.
Nope. Acquisitions don't cost. When you make an acquisition in a year, that doesn't go against your income statement. That goes against your cash flow investing part of your cash flow statement. Now, what it could be is a write-off of an acquisition in the past. That's probably the more likely situation. They made some acquisition, maybe for $30 billion. They go, oh shoot, we paid $20 billion too much. They write off $20 billion. But an acquisition in and of itself does not hit the income statement until there's an impairment charge, which means they sat there and said, oops, we made a mistake. We got to write this off.
Neil is saying that Warren Buffett likes this company, so let's keep going.
Does he? That's weird, because you know why?
Go on.
Look at their return on invested capital over the last 5 years, 0.9%.
Is that good or bad, Paul?
That's not good. That means when they take their capital and get a return of 0.9% on their money, which is not even enough to pay the debt. So now, based on this $9 billion loss, though, if there's a few write-offs in the way, that can affect this 5-year return on invested capital. There's a lot coming to you guys. But here's the cool thing. 2.9% dividend. Their dividends are 4.14. Their 5-year average is 6.45. Okay, so they're eating up 2/3 of their free cash flow just paying the dividend. Okay, so it's a lot of it. From a momentum perspective, the company is currently above all of its major moving day averages, 25, 50, 100, 200, and 300. That's pretty big stuff. So right now, the things I want to look at, oh wow, look at the return on assets, -7%.
That sounds bad.
That's really bad. But again, that's because they lost money last year. You can't really look at that. I should put a 5-year return on assets and a 5-year return on equity and not focus on such low amounts. I mean, look at this book value growth. These are really good, guys. The book value growth of 28 point. In fact, Warren Buffett always reports his book value growth. When you go to his annual report, he talks about the growth of Berkshire. He talks about the growth in the book value. That's what he reports as his returns. 28.6, 13.9. So that tells me that this number is probably skewed off of last year's and other years' returns based on some sort of write-off.
Again, we're looking at Bristol Myers Squibb. This is a pharmaceutical company out of New York. They have several therapeutic drugs: cancer, HIV and AIDS, cardiovascular, diabetes, hepatitis, which Paul has, and arthritis.
You know, it's funny because it's such a random disease. I think the only person I've ever heard of hepatitis was Pamela Anderson.
Yeah.
All right, so revenue, guys.
Revenue growth is pillar number 3, baby.
17.7 to 42. Check mark. Look at this big jump from 25 to 42. That's probably the Celgene acquisition that Mosafine was talking about.
Yeesh.
Net income.
Billion.
Profit growth, pillar number 4.
So it's actually an X because of that big write-off. So let's see what the big write-off was. Right here. No. Right here. 7.63 billion. So even without that, they still would have had a big loss. Oh, special income and charges. Boom. We found the culprit in last year. So they reported a $9 billion loss. They had other income and expenses of negative 7.6 billion, 10.7 billion of special income and charges. So part of your job is to go to the 10K or Google what are these special, because I'm sure when they reported earnings here, you better believe they didn't gloss over this. They had a reason for this. Look at the other years. 300 million, 93 million, 250 gain, $400 million gain, and all of a sudden $11 billion loss. There's your culprit right there. That's awesome. I'm glad to see that. We just have to figure out what it is, because what this is will tell us more about how the company operates. Like, I want to make sure that these aren't, look, the last time they even had a $1 billion write-off was 2012. They had $2 billion. That's a good thing. It means that when they are writing things off, it's not a very common thing. They have some gains in here. So it's looking at like, okay, over the last few years, it's fine, big number. So that's why this is interesting to me already.
So for Bristol Myers, it's only one check revenue growth out of 4. We're at
Yep.
three
But-
X's. But
This is what I like about our process. I'm not worried about Bristol Myers yet. I'm not like, oh my God, avoid. I'm like, okay, they have the explanation as to why they have X's and everything else.
let's look at shares outstanding, which is pillar number 5.
Shares outstanding 1.67 to 2.25. That's an X. There's a big jump in the last year, so I'm assuming they issued shares to make their acquisition of Celgene. Somebody can probably verify that for me, but they even the year before that, they increased their shares a lot, so not a huge fan of that, but they were decreasing. They were kind of stable before then. Look at this. All the way back to 2012. 1.69 to 1.63. Okay, so it's still an X, but again, I'm not that concerned about it right now.
Current assets over current liabilities is pillar number 6.
34 billion versus 20.4 billion. Chickadee check there. Plenty of cash on hand. Free cash flow, guys. Look at this. Uncle Paul. Uncle freaking Paul. Uncle Paul.
You basically made this line to take me out of the show.
Correct. Cash from operations less capital expenditures. I just make it easy for you. I added free cash flow here with the 5-year average right next to it. 2.5 billion to 13.3. And look at their acquisitions right here, guys. They did a $13 billion acquisition last year. They spent $13 billion, and they spent $25 billion in 2019. So they did issue shares both those years, and you see it appearing on their acquisition section. The thing I do different than Y charts, I do acquisition and divestitures as separate lines. That's the cool thing I do. That way you don't just see the net. You see, okay, they spent $13 billion acquiring and they sold $870 million worth. I like that. God, this is such a great website.
You're very proud.
What's the market cap?
I didn't write it. Oh, 140 bill.
140. Their average over the last 5 years is 6.5 billion, which equals 23?
21.5.
Gosh darn it. That's an X. However, I do not consider this an X, and here's why. They didn't have Celgene and these other acquisitions in the last few years, so their 5-year free cash flow is skewed heavily. I would base it more on the last. I don't think this is that bad. Because their last year they did 13.3 billion, so at 140 divided by 13.3, we're talking about 10.7 or 10.8 for price to free cash flow over the last 1 year. That 5-year free cash flow number is heavily skewed by not having those other companies within them. I think for me, the biggest question is that 10.7 billion, company keeps writing, oh, it's acquisition-related charges. Yes, but understand what those mean. Like, they could throw a lot of misleading information in those charges, like know what those charges are for, and add them back in if they're reasonable charges to add back in as a cost to doing business. I'm not opposed to BMY. Look at this.
You want to keep going? I have a question. Before you get there, my stepson Ryan DeLong is asking, is issuing shares instead of taking on debt for acquisitions something you'd rather see?
I would see that. I'd like to see that if the price of the shares are overvalued. If the shares are overvalued, use the shares. Use the shares. If they're undervalued, don't touch the shares. So that's what I don't like here. There's an argument to be made they were probably undervalued at some point, and even now. So why were they using those shares? I don't know. Or maybe they weren't undervalued and they were just selling at this price all along. Let's see that actually. So actually, you know what? That could be a good argument made that when they made the acquisitions at those prices, they were overvalued shares and now they're undervalued. So it might not be a bad idea. Might not be bad that they did that, guys. But issuing more shares in and of itself is not good or bad. It's what the purpose is for it. But I still like to see shares decreasing because I don't like companies who make acquisitions. I feel like they do it for egotistical reasons, not for like legitimate reasons. So anyways, that's where I stand here. But look at this. 8 pillars right here. Right? We have 3 checks and 5 X's. And guess what? I'm not upset about this. I'm not opposed to all this.
Yes.
I don't like the return on invested capital, but I have to sit there and break it down by year.
Do you want to skim the 10K?
Let's go skim the 10K.
While Paul pulls up the 10K, let's head over to the Egyptian, the Nile dreamboat, the dreamboat that is Mo, so handsome, and your brother's here. I mean,
Yeah, where is he?
he's here. He's here.
There he is.
Brother's
Hey.
here. We'll get him on cam here in a minute. But all right, go ahead, Mo. Tell us about trading this
All right,
company.
So this is a 2-year chart that I'm looking at. And the reason that I pulled it out is because, look at this. This is about $67. Not really, can't get through that 67.50 area, and that's over a 2-year period. So for me, yeah, I'm going to zoom in right now and you're going to see what they're doing. They're coming up right now into the sweet spot very nicely. Great bid and ask difference, nothing. All you have to do is get a green candlestick. Is this green? No. Is this green? No. All you need is a green candlestick to break out above yesterday's high right there, and you can go ahead and add to it. But just be aware that your moving averages, that your major moving averages, that's great. But when you get towards that $67 area, be prepared to take your profits. There's a long history of this stock not being able to break through that. What'll push it through that? Jesus. Probably approval of some new drug. Maybe, no, an acquisition wouldn't push it through that. It would be a drug related. So I know that the FDA has, I think it's their PDUFA date for Saturday for
What's
some
the PDUFA
drug.
Date, Mo?
PDUFA.
It's when the FDA makes a decision on a drug. And that is this Saturday for one of their drugs. I can't remember the drug. So if you are in Bristol Myers right now, this is the same thing as earnings. Be very careful. Remember, I don't trade on earnings if I'm on a chart because of what can happen with these gap ups overnight. So depending on what happens on Saturday, there may be some kind of big stock price movement overnight that goes into Monday.
Sharif, jump up there with your brother real quick and let's get you on camera. Now listen, if you're arguing in the comments about why Paul is wrong, at times you'll be arguing with Mo's brother, Sharif. There he is, and all of his handsomeness. And you guys do look like each other a little bit when you stand next to each other. Yeah,
He looks more like dad. I look more
there
like
he is.
mom now.
Beautiful. He's a smile, beautiful person. All right,
Yeah.
all right. Thanks, Sharif. Love you, baby.
Guys, this
Paul,
pipeline is incredible.
Tell me
Look at
about this 10K. Again, we're looking at the 10K for...
I'm skipping immediately to the
Please
phase
do.
1, phase 2, and all these things.
It's lots, isn't it?
Dude, this is hematology alone.
Yeah.
Phase 1, phase 2, phase 3 approved indications. Oncology alone. Immunology alone. Cardiovascular, fibrotic diseases, neuroscience, COVID-19. Look at all these drugs in the pipeline. All these ones in bold. This is a lot, guys. This is a lot. Look how much they have in phase 3. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21. 21 in phase 3 alone. If you guys remember, I was a big fan of Biogen, and they had 26 overall drugs in phase 1, 2, and 3 combined.
That's right.
They have 21 alone in phase 3. The approval rating in phase 3 is around 60%.
58.
Yeah, 58%. So that's 12 right there that they have just based on those stats that are going to get approved. Yeah, this is awesome. I actually might be a buyer of Bristol Myers.
You're loving this.
Thanks so much for watching the video. We hope you were intrigued. If this style of investing speaks to you, click the link below to join our Patreon. As a patron, you get access to a wonderful community of like-minded investors where you can chat, connect, ask questions, and share ideas with badasses like you all over the world. The best part is you get the amazing Everything Money software. This is revolutionary, unlike any YouTube page. You can track your investments, look at stocks, and quickly run our 8-pillar analysis on any company you like. The top tier patrons get direct access to Paul and Trader Mo. You'll see their daily trades, their updated portfolios, and every options contract they write on a daily basis. We provide Patreon exclusive videos just for you, including live streams and exclusive content from our team. Our bottom patron tiers fill fast, so join today. But hey, if you don't believe me, look at all of our patrons' amazing success stories. In comparison to other financial platforms, our software is by far the best value. This is your chance to get serious about investing. If you're finally ready to level up your investing game, join our Patreon and let's start kicking ass together.